Hey there, good morning everybody. Christopher Inks with Texas West Capital checking in with y'all about 10 minutes, almost 10 minutes after 11 a.m. Central Standard Time here on Friday the 5th of February, 2021, San Antonio, Texas. Great to see y'all checking in here. Give me a minute here. Let me do some things here. Okay. Who's already here? I see, oh my gosh, I can't even read your name. It's blue on blue here. Let me see here. Oh, wait, there we go. Is that Base Invest? Hey, good to see you. Let's see here. Universo is here as well. Devin's here. Data. Nevlusian. Data again. Oh, I see. Data coming up on Twitch and YouTube. Hey there, Telluride. What's going on, buddy? Denny, my man's here as well. Sheepdog is here. Good to see y'all. Crypto Mowgli checking in with his purple on blue. You guys kill me, man. Darren, what's going on, buddy? Good to see you. So hopefully you guys have been paying attention here. At the end of the day, guys, we are in a huge range. It's the same thing we've talked about time and time again. I mean, that's the beginning and end of it right there, guys. So try not to get too frustrated at all this movements that are going on in between. Try not to trade the very small movements. I mean, again, that's easiest way to lose your money. You want to make more money with less chance of losing? Zoom out a bit. Trade the larger time frames. Now, I know a lot of new traders don't want to do that because, again, that means they can't get as rich as possible, as quick as possible. But, if you work on the system, guys, it's all about the system in trading, all right? If you develop a system that's consistently profitable for you, that doesn't mean it wins every time, but that means at the end of, months or years, or a year or whatever, that you're ahead. That's what you need to do. If you do that, the rest of it takes care of itself, guys. Time and compounding takes care of itself. If you can develop a system that works for you, your time frame, your goals, all that kind of stuff. As long as you continue to just trade it trade by trade with no real plan, no real system in place, you're most likely going to lose your money. So just keep that in mind. Hey there, Patrick. Good to see you. Ari is here as well. Mark Martin checking in from the UK. Well, thank you for checking in, my friend. Esteban is here as always. Let's see here. How does red on blue look? It looks almost as bad as the purple on blue there, Crypto Mowgli. Telluride describes the Bitcoin range as ranging between wrecked and retirement. Oh, man. Data says, I didn't trade the last 2 days, even closed the charts. Guess what I lost? $0. Okay, guys, so one other thing here before we get going. I just want to continue to remind y'all that to be a successful trader does not mean that you're in the market all the time. As a matter of fact, the most successful traders understand that they should be looking for the higher confidence trades, the ones that make the most sense to enter, not just entering because there's a chance. Remember, it's that movie, guys. So you're saying there's a chance. Remember the name of that movie, Dumb and Dumber. Don't enter a trade just because there's a chance. Because guess what, guys? Even with great risk management, which is what we continue to harp on, and we continue to push, you're still losing money that you don't have to lose. And every dollar that you're losing means it means it's going to take you longer to get where you're trying to get to. The idea is to, minimize your losses intelligently, but the second part of that is not to enter trades that you really shouldn't be entering. And as soon as you guys can slow down and understand that, you're going to get yourself into better trades that don't stress you out as much, that pay off much better. And you're going to take less trades throughout the year, but your growth, the growth of your capital account is going to be a lot greater because of it. I know it's hard to wrap your minds around at first, especially with all this, GME is going up here and AMC is going up there and Wall Street Bets and Reddit and Robinhood and oh my gosh, Bitcoin's going to 400,000 by the end of the year and all this other stuff. It's hard to step back and be a responsible trader. I mean, guys, listen, if all you're going to do is go out there and chase all that FOMO and whatnot, you really shouldn't be listening to me. Other than when I tell you, you're going to lose all your money, most likely. But there's nothing I can do here that's going to help you if you're not going to, if that's your mindset. But again, you just need to remember that's the mindset that loses money. That's the one why the new traders tend to lose their money rather than make it. So you guys absolutely have to understand that. You got to be calm, cool, and collected as much as possible in the market so you're not jumping on these these euphoric hype trains. Every once in a while, somebody might make a lot of money on something, guys. But remember, these are the exceptions, not the rules. In trading, the rules are, the rule is that you're going to make money over time if done correctly. But, again, you guys are jumping in here because you want all these quick gains. And, if you guys are honest with yourselves, you've probably lost a lot of money doing that, right? Join us at howtotradetowin.com, man. We'd absolutely love to have you there. We'll get you in the right mindset. We'll help you thinking about it how you should. We'll explain the market. It's like what I do here, but on steroids. You get a much deeper understanding of what's going on with the markets, macroeconomics, global finance, stuff like that. The things that really matter instead of the stupid memes that everybody follows out there. Guess what, guys? If you're following memes, you're going to be broke like everybody else. All right? Please make sure you understand that. That's probably another ship on the fire. I got everybody talking about Dumb and Dumber now. Hey, Dr. Crypto, what's up, man? Good to see you checking in. Is that George? Hello there. He says, my STF book just arrived. I bought it at my recommendation. Hope it's worth reading. Man, it is definitely worth reading. Right here, man. This is, you know what, guys? I push this so much. Those of you that have been following me a little bit, you know that I just found out about this book, really, last year. And I went and bought it, and I read it because it's as you can see, that Robert Prechter, one of the best Elliott Wave ticians, in the world. He wrote it there. And the funny thing is, I started reading through it. I'm like, man, I've been doing this for 26 years now. Pretty much everything that I've learned in that time is summed up in that book. So you can actually get to my understanding a lot quicker than it took me to get here through a lot of loss and a lot of practice and whatnot. We'll call it practice. But the concepts and the idea that the market, what you guys see on the page, that's not the market. The market is you and me. It's us buying and selling, which means the market is completely emotional. It's not rational. The myth of the rational investor, right? Nobody trades rationally, really. At least not in retail. That's why you have to try to. Everything's emotional. Price moves between fear and greed. People sell when they get scared. They buy when they get greedy. That's why retail generally buys the top and they sell the bottom. They buy that greed at the top, that FOMO, and then they sell that fear at the bottom. My goal with you guys with TWC is to get you through all that so that you understand how it works and you can get to it. Because guess what? Most of the people you're going to follow online, they're going to talk about the lines on the chart, guys. And they're going to talk as if that's the end all be all. But really, that's the last bit of it. If you understand what's going on with society and what's going on with the market itself in terms of emotion, what Prechter has termed socioeconomic theory, if you can understand it from that, it gives you a heads up into what's happening on the screen and those lines and what they really mean. So I would definitely suggest y'all read it. It's an amazing book. We've got the links there in howtotradetowin.com in your account, or if you make a free account on there, there'll be links in there toward that. It's easy, quick to get to. But yeah, guys, it's an amazing read. It's thick, but it's a very easy read, and you'll find yourself going, oh man, a lot of stuff that you thought made a lot of sense doesn't really. Hey there, Bill. Good to see you, man. He's over there stirring up trouble there on the WBS Reddit forum. Don't talk about good risk management. Nobody wants to hear it. They all want to hear, listen, we're going to buy it, we're going to hold it, and we're going to stick it to the man. GME is down how far now off that? I mean, you guys got to take profit. If you're fortunate enough to get into something like that or something that's skyrocketing on anything, make sure you guys take profit. It is not going to go up forever. And the faster and harder it goes up, the faster and harder it's going to come back down. There's no two ways about it, guys. You got to be smart about it. Yeah, WSB. Yeah, Wall Street Bets. I got you. Hey there, Gerben. The name of the book is The Socioeconomic Theory of Finance. Yeah, like Telluride telling you there. Yeah. It's a great book. It really is. Let me see here. Telluride, what are you saying there? You said early good vibe. I've been profitable trader for a few years, but with big weaknesses and gaps that lost me one retirement already. Found TWC and Chris, pretty confident it won't happen again. Man, thanks for saying that. I appreciate that, man. Anybody that's been in there for a long time, guys, if it's your first time seeing me, you don't know anything about me, you may think, man, yeah, he's going to say whatever he needs to say to get people to sign up. At the end of the day, guys, I don't need TWC. I'm fine. I'm doing really well as a trader. But what I found is I really enjoy helping people. I get a lot. It's nothing altruistic out there, guys. I'm going to tell you right now, it makes me feel good. And so I've just continued building this thing, man. And people like Tell You Ryder and others that are in there. Amber Lee, how are you doing? Abs, good to see you as well. We got a lot of members in here, and, they stick around, and they stick around because, we bend over backwards to help them get where they're going. We're not just a fly-by-night thing, guys. We've been in business over 3 years now. So yes, we actually have we're actually in business. We pay taxes. We have a business number, EIN. So, a lot of what you're going to find online, they don't, guys. And, your money's kind of at risk there because, they're not really serious about what they're doing. So join us, man. We'd love to have you here. HowToTradeToWin.com. Let's go ahead and jump in here, guys. Let's see. Bitcoin, what's going on? Here's the Coinbase chart. Just a little simple, what are we looking at here? I've got a 5 count up here, but as I've continued to tell you guys, it is possible this is maybe a 3, and we've got a 4 here, and we've still got a 5 up. But there's contrary to what anybody tells you guys, there's absolutely nothing that's happened yet here that guarantees this is going higher. As a matter of fact, right now, here, the biggest thing to understand is that you've got your higher high up here, right? It's your all-time high. And then you have a lower low here, right? And then you have another higher high, or I'm sorry, this is a lower high. Well, that's a higher high. This goes to a lower high right here. Okay? And this right here is a higher low, but it becomes a lower low over here. Okay? Now, I'm going to tell you why this is important. This is important because right now you've got a high, a low, a lower high, a lower low. This is bearish market structure from the January 8th all-time high. What that means is until you get above this lower high up here, this 40,127 on Coinbase, as long as you're below that, your market structure still says down. Now, we are getting close there. Okay, that's good. Here's the thing. Just because it goes above it doesn't necessarily mean that you're in a new uptrend. You've got to get above this high over here, this all-time high, to say, okay, you're getting up. So you've got to look at this in phases. The big picture is, do we get above this lower high up here at 40,127? If you do, that should increase your confidence. You're probably heading higher. You get above the all-time high, again, more increased confidence. However, with where we are right now, if we were to drop off and head down here below this swing low right here at 28,732, guess what? You'd end up with another lower high, leading to potentially another lower low here. All right? So you want to make sure that you understand that. So you don't get caught into this, oh, it's definitely going to 100,000 tomorrow kind of thing. So locally here, what I think you really want to watch is this ascending channel support here. If price drops down through that, to me, that signals, okay, at least locally here for a while, we've got a top. If we look at this right here, potentially we've got a double top here maybe going on here. If this is done, price has to actually remember, but this potential double top does not become valid until price drops below this swing low. You have to close below, you got to close below this swing low here to confirm this pattern. If that happens, then the double top target here is going to be about $2,500 or so below that point there. So it gets you right to the 1 hour pivot. Makes a lot of sense. You move in up to the pivot to the R1, get rejected, come down, retest the pivot, and then potentially head higher. or you come down to the pivot, get a little bounce, and then continue lower, in which case then you should be thinking this is a top for a bit. Okay? So there's the first thing we're kind of looking at there. We're getting rejected a few times here at the R1 pivot. Bigger picture, you could potentially see this right here as a larger Adam and Eve double top here. Adam being the sharp head here, Eve being the more rounded, takes more time kind of to play out. Again, the idea though, in order to confirm that double top, is that you have to close, you have to close down here below this swing low. If you do that, again, your target then becomes the height here below that point of breakdown there. So basically about $6,400 below this point right here, which gets you to a target down here of around 25,852 or so. All right. The other thing to think about is this ascending channel here. And if you break down through that channel support, there's a channel target based on the height of the channel here of 8,035. So essentially, with these patterns all playing out, you could have your first drop down to the pivot, your second target down here around the S1 pivot, and then your third target, of course, down here at 2581. And in the process, again, it gives us this high, low, lower high, lower low, lower high, potentially lower low. So this is the big picture, guys. This is the way you can watch it. But right now, if you can get above this recent swing high here, that increases confidence that you're headed up. But you absolutely have to get above this 40,127 here on Coinbase to get out of this bearish market structure. Until you do that, you're still in bearish market structure, okay? Let me turn this to a different chart here now. Let me see what y'all are talking about here. Let's see. Yes, Devin's bringing up the TD9 on the daily, as you can see that we have here. And it's a TD9 at the daily at resistance, guys. This green box up here is basically where all this supply is kind of sitting. What does that mean? It means, okay, so price went up here first, and then it was this sharp drop, and it came up and it dropped down through. And a lot of people didn't get to short here, okay? They held on for more confirmation, or they were too scared. So it pops up here, and you'll notice right here, it just barely pushes its way into this box here and gets rejected again, right? So those people that missed putting in their shorts here, put them in here. It comes on down, it comes back up, and then they get hit very strong here. A lot of supply comes in right here. And it's giving you these lower highs off here. And you can look again at the difference between the volume and then the price action of the two candles. A lot more result here, significantly, or a lot more effort here, much larger volume, but much smaller candle spread. Very, very small result. Telling you there's a ton of supply coming in here. We come up here again, and now they're trying to push in again, and they may. It doesn't mean that it won't make it through there. But what this tells you is you need to be aware that this area up here is full of supply. And it's a lot of supply that's coming down on you. And retail is not the one giving you the supply. Retail does not sell into like that. That kind of concentrated supply comes from your big players. All right? That's why we watch these highs and these lows with their price action and their volume here. Okay? Remember, a top is a range, okay? It's a set of price here. A top is not the very highest price. That's an event. The top is the range. The bottom is the range. The event is the very lowest price. Within the range, your big players are buying and selling. They are helping to maintain that range until retail is squeezed dry. Okay? So in a distribution scenario, they're going to be buying the bottoms and selling the tops. But at the end of the day, they're going to be net short. They're going to sell more than they buy. If it's an accumulation or a reaccumulation, it's just the opposite. They're going to buy the top. They're going to sell the tops and buy the bottoms, the top and bottom of the range there, the highs and lows of the range, those areas. But they're going to be net buyers, okay? They have to do this. The idea is that, let's say this, we don't know if this is distribution here yet. It's way too early. But let's say this is. The reason they're doing the range here is so that, okay, so first it comes up here. Retail FOMO's in, right? Boom, FOMO's in, and they get sold too heavily, right? So then retail's scared to buy. So your big players have to buy at the bottom here to send price back up. Retail goes, oh, wait a minute. Okay, it's going to continue back up. And they start FOMOing in again over here because they want to get in before it breaks out. They get sold in too heavily again. They start thinking, man, this is terrible. We're going back down. Big players come in and buy the bottom again. Social media helps them. Buy the dip, they say. Buy the dip. So what do? Maybe you buy the dip, or you kind of wait a little bit anyway. You wait until it gets back up here. Again, you're going to try and front run that previous high, right? Guess what happens? Gets sold right back into again. Let it keep on coming up here. They're going to try and sell it to you again. So, but all along the way, what they're doing is they're testing the retail, in this case, if this was distribution, they're testing retail demand. They're trying to see, does retail continue to pop back, and how much effort are they continuing to produce in spite of all that supply coming in? Because even if this is distribution, guys, if this, I think, like I said, I think this is phase B. By the way, we've started adding Wyckoff back into what we do at TWC per request from our members. So we had this in there now too. But I believe we're in in phase B here. And so what can happen here, even though even if this is distribution, this doesn't have to be the absolute highest price. We can have a move up, and that creates what we call an upthrust. We could have upthrust like that, a move back down, and a move higher up. This is called an upthrust after distribution, in which case we'll continue to go down here. Now, the only way you get an upthrust after distribution is if retail is just exceptionally FOMO-ish and they just continue to buy. Well, your big guys are going to continue to sell to you, all right? But remember, this is all if this is distribution. We don't know yet. It's way too early. We're potentially still just in phase B. Too early to know. But what we can notice is at the highs and the lows, we're getting significant volume. All right? So we want to see if price makes it up into the green box, how does it react here in the green box? That's what we want to see. Until that point, it could fall off right here, and we just keep getting these lower highs and lower lows. And then price ends up doing something like, it comes off of here, and next thing you know, we're going down here again. And then we're coming up, we're coming down, we're coming up, and we're coming down. And it just is this trend down. That's very much possible as well, if it were to be distribution. But again, we've continued to look at the possibility maybe this is a 3 and this is a 4 developing here. And maybe we go higher for 5, but it's still too early to tell. Again, we want to see, does price get up into this green area? And if it does, how does price and volume react there? What's the reaction that we get in that area? That's what we want to see. So, even if, like I said, even if this is a 3 and this is a 4, it's possible we have a 1, 2, 3, 4, and maybe get a 5, just a slightly higher high for wave 5, and that's it. It's an ending diagonal maybe. Of course, it could be a leading diagonal for wave 1 of 5. Lots of possibilities still going on here. Everybody's looking at 50,000 minimum. So from a distribution perspective, it makes a heck of a lot of sense to distribute in this area. Because as long as y'all are still believing 50,000, everybody's still telling you to buy the dip and hold, you're going to continue doing that, which means, you're going to continue to get, and everybody will come in later here. Again, retail tends to FOMO turn, toward the tops here as we're seeing. And they're just going to continue to get sold into. If you're smart enough to buy the dips down here, you're good to go, because even if it comes back, you still got profit. But most of retail ends up FOMOing in near the tops. Again, trying to front run the advance. So if everybody still believes it's 50,000, then retail's going to continue buying in. And if this is distribution, it's a great place to get this, to sell for an average up there of around, 35, 40,000. Until retail finally gets, runs out of, runs out of money to buy. They get exhausted. That's just the possibility, guys. The other possibility, of course, is that it is going to go up higher. And so we're still watching that as well. So what does that mean? Well, okay, so first of all, like we said, we're printing a TD9 here on the daily. Stochc RSI on the daily is right here at about 95, almost topped out and overbought. RSI is pretty high here. It's almost up into overbought as well. If we zoom down here a little bit, zoom in a bit, your 4 hours got some room. But, you know, your RSI is pretty close to overbought. 4 hour bounce just inside of oversold, which says, you know, we could get something like we had back over here at the end of January, where you kind of bounced a little bit and then continued down lower. We could have something like that play out. You know, there's no, I would feel stronger about this 4 hour if it had dipped all the way down toward the bottom of oversold and bounced off the bottom there. But when it bounces here around this oversold area, usually it just kind of plays around, then it comes back down. So we'll see how it plays out there. What we can see here, as far as today's advance right here, price hit the EQ of this 4 hour supply structure here. It got rejected there. We're still printing this next candle. We're still printing a higher low though. In terms of TD sequential, we're at a 5, and no big deal there. We do have this volume picking up on the bottom here, suggesting that there is absorption going on. Let me see here. So, of course, you know, this move up here isn't surprising at all. I do have this descending channel here, and the target based on that is up here at 39,521, based on the height of that channel. So as long as we continue pushing up here, you can continue to remain long, at least to that area. But if you drop through this ascending channel support, again, that target is 29.73 below the point of breakdown. So likely to get you down here around your mid 34,000s. If we jump in here to the 1 hour, here's the bigger picture, I think, of the 1 hour. I've been talking with Discord about this area right here, this support resistance area. Again, you notice you got its support here. Brings down comes resistance, resistance, resistance. Boom, we push up through. Now you need to see it become support. As long as you get support and a move back up and above this swing high here, I see little reason to think it won't at least get up here to 39,521 at least. And then, of course, you've got that 40,127 kind of area as that next kind of target going up. But if you lose this area here, that should all but guarantee you're going to lose support on the channel here, which means, again, that move down toward these mid 34,000s area here. So, I mean, that's how you can look at it. I think that's probably the best way to look at it, as a matter of fact, right now. Let me see here. 15 minute. 15 minute could definitely push some way up here. We're well down and oversold here. RSI is neutral there at about 52. Neutral is 45 to 55. But there's a lot of room here for price to move up higher. So, you know, locally here, I'm thinking higher up until we lose this kind of 37,700 kind of area, until we lose that impulsively. I think we probably still headed up further. But again, once we lose that, and then potentially this, you know, this channel support here, which has already been pierced right here, back on the 4th, so yesterday, you know, I think that kind of opens up the move down. As you can see here on the 15 minute, you have your 15-minute pivot just below that as well. So a lot of confluence in kind of support areas here. So if you're losing this area, that really should kind of have you thinking at least further down for right now. And the further down it pushes, the further these targets it gets, the more likely it is to make an overall lower low, which still does not guarantee that price won't go higher, but it could be, you know, still the whole correction playing out there. Hey there, Gian. It's going great. Good to see you checking in. John Boo says, what happened to the DXY trend reversal? What do you mean, what happened to it? What's going on, Grandmaster? Good to see you there as well. Hey, Brian, what's going on, man? You were sledding outside of Denver? That's awesome, man. So, you know, this is kind of what we're looking here. But, guys, at the end of the day, there's a lot of dollar deniers out there, and they don't want to accept what may be going on with the dollar. Maybe. The big picture of the dollar is this, guys. The big picture is this. If this is a reversal here and the dollar is going to start trending up here like this, everything denominated in dollars is going to lose value. Period. It's not what I'm just saying to say. You got think about it. If the dollar is worth more, if the dollar increases in strength, becomes worth more, then it takes less dollars to buy whatever you're trying to buy with dollars. Because your dollar is worth more. You guys get that real easy when you think about inflation. You think, oh man, there's more dollars out there. That means the price is going to go up. And you guys don't have any problem with that. But usually when it comes to deflation, the opposite side of that, you kind of sit there with your thumb up your rear end. And that's not good. That's a very, you can notice that that's a very emotional response. And I get this most from those who are emotionally bullish on Bitcoin. Because if I say, listen, the dollar's going up, and if the dollar's going up, that means the value of Bitcoin's going to drop, they instantly take it personally. I'm not trying to hurt you personally. I'm trying to let you know that this is the way it works. I didn't come up with this. I didn't decide this. This is the way it works. If your dollars are worth more, you can buy more for less. Now, can Bitcoin or something else rise in deflation? Theoretically, sure. You would have to have more demand, significantly more demand coming in, though, than what we have right now. Because you would have to, all that extra demand would be needed to push price up, and it would have to first overcome the deflationary aspect. So you've got to get enough demand coming in just to keep it even, just to not lose value. And then you have to have more demand to rise in value. And you go, oh, but that's great. Everybody wants to be in Bitcoin, right? No, they don't all want to. Especially not in a deflationary environment. Because what you need, retail coming into Bitcoin is not going to do it. You need your big institutional money. They have the guns. They need to come in to prop up that price and push it up. The problem with that, though, is if you're big money, if you're an institution or whatnot, again, as I continue to preach to y'all, first rule is to protect your capital. Second rule is to grow it. They are getting in Bitcoin generally because they're trying to protect their capital in case of inflation. Well, if deflation comes, that's the opposite. That means if they're in Bitcoin, they're going to lose value. They have absolutely nothing, no reason to stay in Bitcoin at that point, which means supply pressure. And as price drops further, even those that are trying to hold out even more are going to at some point say, listen, I can't keep taking the loss on this. You say personally, oh, well, but so what? We go into another 2-year bear market and then it comes out and goes up even higher. They can hold during that time. They're not going to. That's the thing. They're not going to hold through that because it's risky. Listen, if the dollar goes up, that creates what we call a risk-off environment. And in a risk-off environment, everything else drops. Stocks, precious metals, everything. Because everybody, the risk, there's no risk. People don't want to be in risky assets. They take their money out and they put them in T-bills or something. And so if that happens, where is all this extra going to come from beyond what we're getting right now, what we've gotten coming up, that we would need to do to not only just keep it even against deflation, bringing it down, but then to extend it beyond that. And this is the reality, guys. If deflation comes in, if the dollar continues to rise. Now, there's no guarantee yet. It's done a couple of things we needed. It got through this wave 4. It got through the descending resistance. I think those are pretty significant. But we really need to see it get above wave 4 up here, this larger wave 4. Because you got basically a 1, 2, 3, 4, 1, 2, 3, 4, 5 is what we're looking at. So you need to get above this one to kind of say, okay, this is closed out now, so we should be heading higher. It's around 95. So until we get above that, I'm still cautious about possible one more move down here with the dollar. Right now, this is a pretty good move so far. Potential head and shoulders here, right? Left shoulder, head, right shoulder, pump up and through. You've got the larger candle spreads coming out of that. That's what we look for. Let me see here. Oh my gosh, let me see here. Let me get rid of some of this, guys. Give me just a minute here. And get rid of all this on these larger time frames so we can see it a little bit better. But I hope you're at least seeing, no matter what you think of Bitcoin, I hope you're at least seeing what I'm talking about here. And the problem with being overly emotional at this moment with everything that's going on. Because there are other possibilities. Remember, part of a big thing that's been growing quite a bit here in Bitcoin and cryptocurrencies is the lending, right? So they say, hey, listen, don't worry, you've got assets, don't sell them and have to pay those taxes and whatever, just take a loan against them. And then if you take a loan against them, then you don't have to pay the taxes, right? Because there's not taxes to pay because you're not actually selling, right? Well, the problem with that is okay. If the value, let's say you're using Bitcoin as your what do you call it? As your collateral. Okay. And so a lot of these are like, depending on whatever, they're anywhere from, depending on the cryptocurrency you're using, they're anywhere from 30 to 70% collateral. So loan to value ratio. So let's say you have 10,000 in Bitcoin and there's a 50% margin requirement. You can get a loan for 5,000. Now you have to pay that loan every month, right? If the margin drops below 50%, the system automatically sells your cryptocurrency to bring it back to bring your margin back up. Think of it kind of like what the exchanges do, when you get liquidated, where they liquidate part of your position to get your margin back where it's required. Same idea. So two-pronged thing here. Price falls of Bitcoin or whatever you have there as your value, as your what you're using as collateral. And so that puts you in danger of a margin call, basically, more or less, I guess, whatever. So where they're going to sell part of your cryptocurrency that you've pledged as collateral, to keep your margin where it needs to be. Now, let's say you add that with an economy that runs off the cliff. All of a sudden you get this hard drop in the economy. Everybody starts losing jobs. Things are closing down or whatever. So how are you able then to either pay enough to pay off your loan to get your crypto back out or to make your payments every month? You lose your job? How are you going to make your payments every month, right? And so then all of a sudden you have this potential cascading loan liquidations going on, which again just adds more supply to the spot market, bringing price down even more. Have you thought about that yet? Because I haven't found anybody that I've been talking to yet that's actually thought about that. I'm not saying that's going to happen, but I'm saying if you're not aware that that's a possibility, what the heck are you doing in the market? If you choose to close your eyes and plug your ears, go, nah, I'm not listening. I mean, do what you need to do, but at the end of the day, you're going to lose money. The problem is most people who are in the market are gambling at best. They don't know what they're doing. They're throwing money in, closing their eyes and going, God, please let it go up. Please let it go up. The reality is, guys, if that's how you're trading, you're going to lose money. There's little in the way of doing that says anything positive about, you making money. So again, the whole thing is, and this becomes more spectacular the stronger that the DXY pushes. If we look here, this over here was March. Remember March? Right here, this is March of last year. This is when we had the big drop in Bitcoin, the big drop in stocks, everything, right? The harder and faster the DXY pushes up, the harder and faster the other assets are going to push down. This right here is a result of liquidity issues, because when you have a whole bunch of people running for the dollar, they become sparse. And you have higher demand for them, which pushes up price higher. Again, all these concepts you understand emotionally when you're thinking about Bitcoin and your stocks that you want to go up, but you have trouble emotionally applying them back. And that's where the issues come in. So we want to make sure that you guys don't have that issue now when you're doing. That's why I discuss this, why I talk about this, why I remind you of it. This is why I describe how this could play out potentially. But until it does, there's no problem with continuing to ride the market, guys. The idea is that you get an understanding of what could happen and what that means and what levels you're looking at. So that way, if something does happen, you know, listen, that looks like it's probably happening. I need to go ahead and lock in profits. Man, we see it all the time. New traders come in there, they talk about all these profits they have. Paper profits. These are things that they haven't realized yet. They have not locked in their profits. And then price takes off and goes the other way, and all of a sudden they can't get themselves to sell because, oh my God, that's going to be, you know, now I've lost all this money from where I was instead of paying attention to all the money they have from where they started. And emotionally, psychologically, they can't sell. They just can't seem to get themselves to sell. Price keeps dropping. And most times, they're lucky if they break even, but most times they end up with a loss when they could have had a great profit. These are the kind of things you want to avoid. Let me see here. Mark says, it depends when Bitcoin increases. It increases more than the dollar has moved in decades in terms of relative value. I don't think this movement is at all because of the devaluation of the dollar. The dollar would have to rise significantly for it to have much of an effect on Bitcoin, in my opinion. Well, Mac, I'm sorry, I said Mark. Mac the man, all you've got to do, man, you just got to bring up your charts, man. Compare it. You'll see. Compare Bitcoin to the DXY. Compare the stock exchange to the DXY, the indexes. You'll see. Your opinion is not correct, unfortunately, based on everything that's happened here with Bitcoin and everything. You know, it moves opposite. I can bring it right here. Look, here's the BLX. It's this blue line right here. Let me see if I make it a better color so maybe you guys can see better. Yeah, you can probably see that green a little bit better. I'll make a thicker line there. There you go. You say it's not going to have much of an effect, but let's be realistic. There you go. And you say, oh, but Chris, look, it's rising when it's rising. Well, it doesn't move at exactly the same thing all the time. What you're looking at is overall. Does it move in tandem or against it? So we can look right here to right here. And there you go. Now, when you have assets like gold, silver, Bitcoin, they usually move before DXY. So they usually reverse prior to the DXY reversing. So that's why you get things like this, where you may have it going a little bit in the other way. Oh, there's going there. But the reality of it is, if the DXY is moving down, Bitcoin's going to go up. But if it's the other way, it'll often be the other way here. So again, you have this move up here. If we look here, right here, and you say, oh, but Chris, look, it only went down in this part, and here it kind of went up. It didn't really go up. What you're looking at here is that Bitcoin went sideways. Because the DXY in general here, bigger picture here, from 16 has gone sideways. It's not going to be the second that the dollar drops, other things are going to rise. The second the dollar rises, other things are going to drop all the time. What you're looking is for the larger correlations that you have there going on. And it's clear historically that when the dollar is rising, Bitcoin gets hurt. Now, that didn't happen at the very beginning of Bitcoin. Why? Because Bitcoin was a very, very tiny, it had very little money in it. It had very small market cap. The people that were in it were just, you and me, and, I wasn't in it back then, but, they were more retail than anything else. But now that you're institutional investors, the one you guys have been wanting to get in, now that they're in, as I warned you 2 years ago would be, when they started really coming in, Bitcoin is going to then act more like everything else does globally, because it becomes part of a bigger thing. These big guys that come in, you guys come in, you go, okay, Bitcoin's my only thing I'm doing, or crypto's my only thing I'm doing. You don't have an extensive portfolio. This larger money that comes in, Bitcoin becomes a part of their portfolio. So they will ease in and ease out of it, or sell in out of it sharply, as their portfolio requires it. All right? It's not going to be like, oh, what's Bitcoin going to do here? It's like, okay, how is that affecting my portfolio? Because they have people who they have to answer to. If, Sailor's going on here trying to get all these companies to put it on their treasury. Well, the problem with putting it on the treasury books is all of a sudden you have not just what you want to do, but you have your executive board, you have your shareholders. And so what happens? If they don't like what you're doing, guess what? They sell your stock. The price of your stock drops, which is not good if you're a company, because you want that higher stock price so you can take advantage of debt issuance and whatnot. So it becomes a real issue at that point. You can't just hold on because you want to hold on and that's all there is to it. You have things you've got to do. You've got people that you are responsible to. And it doesn't matter at the end of the day what you think is good, right, or otherwise. It matters what do your shareholders think. Because one, if they're smaller, they're just going to sell and get out. Drops the price of your company, drops the value of your company. If they're larger, it could create some kind of takeover or some kind of shareholder activism, which makes your life a whole lot tougher. These are a lot of things that you have to watch out for in there. Hey there, Sir Hole. Good to see you. Chemo in here as well. Let me see here. Yeah, Mac, I think you're being really emotional about your analysis there, my friend. I don't know what else to tell you. I can explain to you the way things work. But I can't force you to want to listen, really listen. As far as this goes right here, what's going on? Prices driven up dramatically here on the DXY. It's continued to press up. So now we get this. And it looks like we were just in a finishing up wave 2 here. It looks like right now it's just wave 2 of wave 3 heading up. We're almost at the 50% retracement, not quite yet. We've got an A, we've got a B, working on a C here. I would expect something around here. As you can see on the 1 hour, we've dipped down into oversold, bottomed out and oversold in Stochc RSI. 4 hour, Stochc RSI is down and oversold now. The R1 pivot, the 4 hour, the 1 hour sits right there around 90.95 or so. So we're going to continue to see if we get that and we get the reversal up out of that. Because if we do, let's say it makes it to the 50% area there, and really all it's doing is coming back right now in terms of this large channel that it broke out of. It's just pulling back to retest resistance as support at the moment. So let's say it does make it here to 50. Well, all of a sudden, if you make it to 50 there, your wave 3 is up here at about 93. Your wave 5 is up here at 93.5. And that wave 5 is only then wave 3 here. This is blue wave 3. So that becomes wave 3 there. So you get a wave 4 pullback and then you get a wave 5 up. So a lot of advance still going on. I think the biggest thing about the dollar right now is what I've continued to talk about, which is this large, almost a year-long channel resistance here, which it broke out of, and right now it's trying to retest as support. If it gets that retest as support, I don't know how you act bullish or how you act bearish on it, other than if you want to be emotional. It doesn't make any sense how you would be bearish on it breaking out of this channel resistance here. And remember, based on the height of this channel, this breakout here should give you a target of about, let me see, just real quick there, just about 5.2 or whatever, above that point of breakout. So we're looking up here at around, I don't know, probably around 96.28. What does 96 do, though? It takes you above that magic wave 4 area here. And getting above that, really, this locks in this is being done here. It doesn't guarantee that price is going to head back up here, but I'm telling you what, if DXY is hitting up here at 96, there's little in the way the other assets can really do to fight that. Again, the idea is that in order for Bitcoin to continue to rise, you need significantly more demand than you've already had coming in. The problem is that has to come from your big money. And if the dollar's rising in value, they're not going to be interested in sticking their money into an asset that's losing value. Again, they're doing it as we've seen. We saw the interviews. We've talked about it before. They said, listen, we're getting in because of potential inflation. Again, that means that if there's no inflation, and worse yet, there's actually deflation, that's the exact opposite reason why they got in. So there's no reason for them to stay in. Let me see here. Yeah, sorry, George there. Thank you, Telluride. Brave New Coin Index is the BLX. And we use that because the BLX goes all the way back to, 2009, 2010 when it first started. None of your exchanges go back that far that we sit on there. So it just gives us a good kind of picture of what's going on there. But, again, guys, the dollar has to continue up for this to happen. As long as the dollar doesn't continue pushing above 95 and continue up like that, then I think, your other assets potentially are going to be just fine. Mac, again, you're talking... Man, I hate to say it's nonsense, man, but really that's what it is. You said it depends whether they expect higher prices regardless of the dollar rising. They're not going to expect it. They're much less risk tolerant, guys, because they have a lot of money on the line. You're talking tens of millions, hundreds of millions, maybe billions that they'd be willing to put into Bitcoin. So we know historically Bitcoin can crash 50, 80, 90%, right? You're going to tell me somebody's going to be okay putting in 500 million and it dropping within a month or two down to 500, or let's say put in 500 million, dropping down to 250 million? No. Because there's no guarantee it's going to go up, or that it's not going to take 2 years to get back up to where it was. And that's money that they need to either protect or put to work. They're doing neither if they're in there. If they think price is going to go up higher and they can get it lower first, they're not going to get in right now. That doesn't make sense to them. You see what I'm saying? This is where you have to think about this stuff, guys. And the problem is, if you guys have never dealt with people who have this kind of money or are in these types of positions, it's hard to understand. It's hard to get out of what you think as a retail investor and how that differs from what they think in their particular positions. John says, how can DXY rise with the money printer going? Because it's not what you think. You guys really need to stop watching the memes. You got to do your homework, guys. Don't be lazy. I've put a whole bunch of links in a thread. You'll have to go to my Twitter there at TX West Capital and search up QE. I've got a tweet in there with 5 or 6 different links explaining QE and why it's deflationary and not inflationary. It explains to you how it happens. To put it in a nutshell, guys, most of that money that the Fed is printing goes into the Fed's vault, and that's for banks to use as collateral so that they can loan out. Real money creation comes when banks give out loans. It's credit expansion. We are in a debt-based economy. That means the only thing at the end of the day that matters is credit expansion or credit contraction. We've had contraction over the last year. This is a very terrible thing for a debt-based economy. So the money that the Fed actually prints, in general, most of that money doesn't actually get freely flowing out here, guys. It sits in a vault that legally cannot be touched. Banks can reference it as their reserve so that they can put out more loans. The problem is, over the last year, the banks have tightened their credit qualifications. What the Fed's doing was supposed to encourage them to open them up and give credit to people who maybe didn't deserve it, as much as people who have a lot worse credit history than what they would normally give. But they didn't. The bank said, screw that, man. We ain't going to do that. And so we saw credit contraction through 2020. And so again, at the end of the day, if you want inflation, you need credit expansion. So not only do we have less and less people that came through last year to actually take out credit, but we had a lot more people actually paying off their credit. Now, when you talk about dollars, you keep talking about Fed printing and how that means inflation, which again, as I just explained, is not what you think it is. But the other side of that is dollar destruction. And dollars are destroyed when credit is paid off. So if you're paying down your loan, you're getting rid of dollars. Those dollars are going back. You're destroying the amount of dollars that are out there in circulation and moving around and whatnot. So we had both those things last year. We had, first of all, we had less people trying to get credit. And then we had banks making it harder for those who were to get credit. And then we had people actually paying down their debt at a historic rate. Two things there that were happening that weren't what the Fed needed. So that's where we kind of were with that. But that's how that works, though. But also the value. Remember, the value of the dollar here, the DXY, is based on the value of other countries' currencies. So if you watch, 57%, something like that, of the value of this DXY value here is weighted toward the Euro USD. So how well does the dollar do against the Euro? Dollar's been whooping up on the Euro for a while now, which is why they're almost mirror images. If you throw the Euro USD on there and compare them, you'll see they're almost mirror images. The USD yen is the second largest at about 11%. And man, oh man, the dollar strength against the yen has just been stupid crazy here recently. It just kept on ticking up without pulling back. And then third, I believe, is the dollar against the Swiss franc, probably around 4% or so. So if you have, and the dollar's been crazy moving against, gaining against that, against the Swiss franc. So between those three, 70 somewhat percent, just over 70% of this 91 value here is derived off those three. And the dollar's been crushing them all. So that's why you get the DXY's value rising. And part of it, so how does that happen? Well, because then you say, okay, yeah, you mentioned something you said about the dollar compared to other countries. Sure, or the printing. It's not just enough to say, okay, how much is being printed, but then you have to compare that printing to what is your GDP and a few other things. And I put a link on that as well. You'll have to search through my Twitter feed there to find it. But what we found is that the Bank of Japan is the worst off, is worse more than all the rest of them off. The Euro, though, the ECB, the Euro Bank there, is second bad. So these two are doing worse than the USD, even though the USD is printed so much. So again, the dollar doesn't have to be just great. It just has to be better than the rest of them. Now, you got to also understand that the rest of the world, a significant portion of the world's debt is U.S. debt. U.S. debt, by law, has to be paid with U.S. dollars. That's why you get this here, this liquidity crunch here. Because everybody's rushing to pay those dollars, to buy those dollars. Because guess what? If you owe money on U.S. debt, and you have to pay, again, with dollars, then the higher the value of the dollar rises, the more expensive your debt becomes. If you are a debt-based economy, the reason why you need inflation, a small bit of inflation, is because you want to pay off today's debt with tomorrow's less expensive dollars. If tomorrow's dollars become more expensive, then you are paying more debt for what you're doing, in addition to the value of what you bought going down. So again, we'll use Michael Saylor's $650 million debt issuance, right? So they went out there and they issued $650 million of debt instruments just recently to buy Bitcoin, right? So here's the problem. If the dollar goes up in value, it does two things. One is it makes the value of their debt, the value of things drops. So whereas they had $650 million in debt, it could potentially drop to $400 million or $300 million, okay? That's the value of it. But you took it out as debt, which means you owe money based on 650 million. And on top of that, with the rising value of the dollar, your dollars are becoming more expensive. So not only is your debt worth less than what you financed it at, but now you have to pay back that finance with potentially 50% or greater cost as the dollar rises. That's a double whammy, folks. And that's the big problem when you have stuff like that. And maybe not even so much with companies, though bigger companies are definitely going to be it. But when you think in terms of countries, that becomes a real issue. There is a recent article here about the offshore Chinese debt. So about $18 billion loss. $18 billion not being defaulted on, U.S. debt from Chinese manufacturers and whatnot. That's a lot. That's just the beginning. They expect a lot more throughout this year. This is where the problems start coming in, guys. But most of retail doesn't know this and doesn't care to listen to it because it means, oh my gosh, Bitcoin may not go up to 400,000 like they want it to do this year. But you can't be doing what you're doing here and ignoring what may be happening, guys. Just closing your eyes and plugging your ears and going la, 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 and pretending it's not happening doesn't mean it won't happen. Now, we're still away from that. It still hasn't happened yet. But we're seeing all these signs. Again, this huge, the 18 billion? 18 billion in the face of a few trillion maybe isn't all that much, but it's significant enough to get your attention. It should be significant enough to get your attention. We know in the U.S., we had the greatest rate of company bankruptcies last year. Some I had told you earlier in the year was going to happen, and we got that. All these things add to this deflationary aspect or a debt deflation spiral. And there's absolutely nothing the Fed can do about it. There's nothing central banks can do about it. It happens because the credit bubble gets too large and people decide, listen, I'm not taking out anymore. So there's no more expansion of credit. And if there's no more expansion of credit and you're a debt-based economy, guess what? It drops. And that drop forces people to sell things cheaper so they can pay their bills so they can do things. Not just people, but then you go companies, you go countries, right? So then things lose value because they're being sold for cheaper and cheaper and cheaper. So they can buy more expensive dollars. Dollars don't get spent as freely. People save them because they're concerned about, are they going to lose their job? Are they going to be able to pay their bills this time around? Your savings rate goes up. Again, like we saw in May, we had a 30% savings rate here in the U.S., largest it's ever been. Something like that. This is all bad. This is bad for a debt-based economy. This is deflation when that starts really ticking in like that. So that's the reality, guys. Is it going to happen or not? We'll find out. But right now, there are a lot of things going on that suggest it's a very real possibility, which is why we discuss it. Hey, what's going on, Spar Architect? Good to see you. Man, thoughts on the government wiping out student debt. Yeah, I know, this was always a possibility coming in. I don't think it's going to be a wipeout of student debt. It'll be limited, like, maybe 50,000 or something like that. So is that really going to help a whole bunch? I don't think so. So many people have taken out so much loans that it would be a small ding in the bucket, I think. But they can the Democrats can step up and say, look what we did for you if they do that. But I don't think it really is going to have a substantial effect on probably the largest portion of students out there. Now, if they do, here's the thing though, if they do extinguish, even up to 50,000 there, you have to pay taxes on that money. It's considered kind of like a gift. And anytime you're receiving money, you're supposed to pay taxes on it. So you'd still have to pay taxes. If you did 50,000, you'd have to pay taxes on that 50,000 because it's considered, money coming in, income, something that you got. So you still have to pay taxes on that. Now, I mean, obviously, in the grand scheme of things, if I have to pay $5,000 or $10,000 tax on a $50,000 windfall, I mean, I'm net good, right? The problem is who's got $5,000 or $10,000 sitting in their bank to pay that. So what other issues come out of that now? Because you're going to have to pay taxes on it. They're not going to say, no, you don't have to pay taxes on it. The rules are anytime you've got money, it's income. You got to pay taxes on it. Yes, exactly. Like a short sale on a house. You owe taxes even after you lost the house. Yeah. My thoughts on increasing minimum wage. Realistically, guys, the average, I know up prior to the pandemic, I know the average wage in the U.S. was about $21 or $22. So raising the minimum wage, I think it's a feel-good thing. I don't see the economic impact of it. What we have seen is places that have done it, Seattle and a few others over the last few years, they saw a large amount of jobs were lost. Because, just because you tell a company they have to pay $15 an hour doesn't mean they can afford to pay $15 an hour for a job that they could afford to pay $8 or $9 an hour to. So you're going to get companies that are going to loosen their employment. They're going to have less employees. They're going to go more automation because it's cheaper and it works, 24 hours. So they hire one person to take care of that automation, which ends up costing them altogether less than if they had 4 people doing that same job. So yeah, it forces a company's hand, as far as what they can pay and what they're willing to pay and whatnot. And here's the thing, and so how does that really affect overall? I don't know that really increases a whole lot of the income aspect, spendable money that makes its way into the economy. I don't really see that yet. Yeah, exactly. Tell you, Ryder says raising minimum wage seems bad for small business and lobbied for by big business. By the way, guys, if you don't understand how government works, especially here in the U.S., it is designed for the thing we hate, lobbyists, right? And who has the lobbyists? The large companies and the large organizations. Your steel workers, United Steelworkers and whatnot. They spend a lot on lobbying, stuff like that. But the reality of it is, if a government is susceptible to lobbying like that, then most likely what you're going to get are regulations. And what regulations do is they create barriers to entry for other businesses. So your big businesses get in there and get these regulations passed. They lobby to get these regulations passed, which then they're already in. It just makes it difficult for competitors to come in. All you have to do is look back, if you guys don't know the story of corn syrup back in was it early 80s? Look that up. Same idea. Corn syrup lobbyists going in there, getting the government to make it difficult for real sugar, and then everything goes to corn syrup, and then that's what you find in all your drinks and everything today. Instead of sugar, you find the much worse for you corn syrup. By the way, if you didn't know it, corn syrup is really bad for you. So yeah, again, this is the way that government works, especially here in the U.S., which is designed that way. Viginti, I'm sorry, man, if I screwed up your name there. He says, you feel like it will just cause more unemployment, which leads to UBI. The U.S. has a strong history against universal basic income. Maybe it'll come through at some point. But here's the thing. Everybody's like, oh, well, that's the answer, right? Let's just give people payments directly, right? Universal basic income. Well, first of all, with the way our laws are set up, the Fed cannot do that. The Fed cannot give you money directly. Matter of fact, what they've had to do just to buy up these assets and these corporate debt and everything here this year was they had to create all these different special investment things and whatnot to kind of jerry-rig it all together so that they can make the money funnel its way into the asset market. But, it's always possible the government, the Congress could pass a law that states that they can create, direct payments. But here's the thing, guys. Even if there's direct payments coming out there, it's not going to be as great as y'all think it is as far as how much money you're going to get. And then the problem comes, okay, well, are you really going to spend that money if you think the economy's going off the cliff, if you're worried about your job? The odds are you're not. You're going to save it. And again, it just becomes, okay, well, all this money's being printed and actually put into circulation, but then it's being sent to the bank and held. Again, you don't get the inflation that you're trying to get. So I kind of think that's where we are with all that as well. Guys, there's a lot of moving parts here. I want you to understand that even what I'm saying, even if it comes off as maybe very convincing to you, at the end of the day, neither I nor anybody else, the central bank does not know exactly what's going to happen when it does the things it does. Remember, for the past 20 years, they had certain thoughts under Bernanke that they continued to press that they found out here in 2019, 2020, that all of a sudden those things were shown not to work. Premises that they had. And so the Fed is doing things now that it really doesn't know what the result's going to be, whether it be short-term or long-term. Right now, the Fed's interested, really, it's not interested in interest rates. It does not want to go below zero. We know from the research that's been done that negative interest rates don't really spur economic growth. They don't really spur that inflation, get it going there. So they want to concentrate on the yield curve. The yield curve is a very complex thing. And so, we do our best guesses on what might happen, but nobody really knows for sure. I think it's important to kind of listen to both sides of it. We talk about it all the time. What is the Fed doing? What do they think? What are they trying to do? At the end of the day, all the Fed really can do right now, guys, and what I've told you they can do is their firepower is their mouth. They have to get you to believe the things they're saying, because physically they really can't do it. They can't force you to spend money. In order for this economy to continue to heat up again, you have to go out and spend money. But they can't force it. Are they going to come to your house and put a gun to your head and say, hey, listen, you need to spend that last $100 in your bank or we're going to, blow you off your head or something, they're not going to do that. And as long as they're not going to do that, you're not going to spend that $100 if you think you might need it for something, especially for rent or food or something like that, gas for your car. Lord knows y'all are on wireless phones, right? Your phone package, your phone plan. That's the reality of the situation. Just because the money gets out there doesn't mean people are going to spend it. Even if that was the case for money to get out there. But money does have to get out into what they're doing out there. And right now, the way money is created is through banks, not through the Fed. It's really through banks and their loan creations. So if you're not out there taking out loans, and especially if you're out there not only not taking out loans, but paying off your loans, that's the Fed's worst nightmare right there. Let me see here. Let me see. Let me kind of catch up with you guys here. Let me see here. So we'll look at that real quick. Let me kind of pull up a few things here since I've been talking about this all a lot here. Let's kind of look at some charts here, guys. Because what's going on, what I talk about with Bitcoin and whatnot, is going to be what you're going to see with gold and silver as well. There's no reason to buy gold if it's going to drop in value, right? That's just, the reality of it. Why are you going to buy something that's going to increase or decrease in value? You remember your goal is always to buy things that are going to increase in value, right? Or at least to make sure that your money doesn't lose value if the value of your currency is actually decreasing, right? Let me see here. So let's go ahead and jump out here. Let's take a look here real quick. Remind y'all that have been here a while, and for those of y'all that have maybe never seen this, again, this is still my gold view. Right now, I'm still looking for it to come on down here toward $900 down here. I'm looking at this right now as a expanded flat. So A, B, C coming down. We'll see. Right now, it's trying to find support on that weekly pivot right there. But the floodgate should open up if it drops below this swing low right here at 1767.20. And you say, oh, wait, what are you thinking? You're such an idiot. There's no way it can go down there. Sure it is. I'm showing you the path right now. And if we think about the deflationary argument, well, this would make sense. We would expect this to come down if deflation comes in. But there's no guarantees yet. Nothing's really done this yet, Again, bigger picture here. You want to see it get it down through this larger wave X here, wave circle X, at 14.50 and 90 cents to really kind of, clue it in there that it's probably headed down. But locally here, we've just got to get down through the pivot on the weekly and that swing low there. And that opens up the move down toward this larger X, We get through that, that moves down, toward here, of course, but really kind of once you're down to the lows, you're really starting to look down at the bottom there for it. So, I mean, this is kind of what we're looking for, big picture with gold. And we've been talking about this, guys. Listen, for those, we have members with us that have been with us the entire 3+ years that we've been in business. And so they will tell you that we were talking over here about buying with a target, a minimum target of 18 to 1900. So, I mean, this was back in 2017. So a lot of our members got in gold down there and they made crazy money, riding that up there with it. But let me do this here. But let's look locally here. Locally, we've potentially got this going on right here. We've potentially got this 1, 2 here, and then a 1, 2. Now on the daily, we're well below the pivot. We're bouncing off the S1. The expectation should be a reversal off here and a continuation further. If so, we've got a wave 3 target here. It's $1,617.80. Well, that takes us below that swing low we talked about needing to get below, this one over here, the $1,700 one. So that's your first step. And that's just a wave 3. That's a 3 of the larger 3 heading down there. So 5 will probably get you down here in your mid-15s, maybe high 15s. But if we look at this here as a 1, 2, 3, here, we should be looking for a minimum wave 3 down here of 1,442. It's a pretty significant drop. That gets you below, right below the larger wave circle X that we talked about. Nice descending channel. We'll see what happens here. Right now, locally, as long as this swing high up here at 18.78.90 cents holds, we should be looking to go further down. If we get above that, it's possible we could go higher. In that case, we might look at this as an expanded flat for a wave 2 here. So you've got wave 1 down, then you have ABC up for A, ABC down for B, and then you'll have 5 up for C. And, in that case, we could see it rising. See here. We could see it coming up here around 1900, maybe even 1923. That'll get you to 78.6 as an expanded flat. But in that case, you just need it to stay below this wave 2 up here in 1962.50. If price continues up through that, then I think you can start looking at much more bullish counts. But I think as long as it remains below this larger wave 2 here, I think you should lean heavily toward a bearish move rather than a bullish move overall until it makes that up. Remember, again, high, low, lower high, lower low. Let me see, what is this here? 1966.10, 1962.50. So we got a lower high here. As long as this gets down and pushes to another low. So potential lower high coming over here as it does. Let me see here. Let's see here. But, again, nothing's guaranteed yet. So we definitely, if you're thinking downside, you need to get below this swing low here. That increases the odds significantly. But again, if you're moving up, even if you get above this swing high, that may be your first clue that maybe, it's heading up there. And this would have to be like a 1, 2 here. But still with the bearish count, it could be a 1 with an A, a B, and then a C as expanded flat. So, you can continue to trade it up there. If it reverses, lock in your profits, go short again. But if it continues up through this wave 2 up here, well, now you're coming down through this descending channel resistance, and that starts building a strong case for this being a 3, this being a 4, and then this working on a 5 up. Which, again, our other one, and that should see price probably getting around, I think we were looking at 2,300 if it did that. Something like that. So, just some things to think about there. Now, all of y'all or many of y'all may be interested in silver, right? Because, all the nonsense going around about how, WSB was going to short silver or, kill the shorters in silver and all that. Which of course, if you're in Discord, I posted some good links on that silliness right there, on why that's all silly to even consider there in the macro finance channel. So you guys can check that out. Right now, we were looking at potentially this getting a 5 down here, but if price pushes up above this wave 4 here at $27.26, then we'd be looking at this being a 1, 2, 3, 4, 5 here. So basically your 5th wave done would be that there. And if that's the case, that means wave 1 is done here. And we'd be looking for wave 2 then to pull back. We usually look around that 61.8 to 70.5, which makes a lot of sense. There's a lot of activity going on here. You can see a higher volume node there. So that's where I would be looking for it to go. If we're going to get above that, and this is potentially as an ending diagonal here with 5, then we should get an ABC up here toward 28,655 and potentially $29.04. Now, it could continue to go up 78.6 or whatever, but I think that would be most likely where it get. The 65 looks like a good target. It's right there around the high volume node at 28.795. And then we'd have it coming down further if it gets above that area right there. Could this be an ABC down? Honestly, if we look at the advance off the lows here, you'd be looking at this as a 1, and this is a 2. Well, no, I guess you got to look back over here, right? It's declined so far that it makes it highly unlikely. It doesn't mean it can't. It still hasn't impeded on wave 1 here. So this could still be a 1, maybe a 1, 2, and I don't know, somehow this becomes a 3, maybe a 4 up here and a 5 to make 3. But I think the count here works a lot cleaner. 1, 2, 3, 4, 5 as an ending diagonal for wave C there. And then we get this move down. It just seems structurally like that makes a lot more sense. So we'll have to see how it plays out. Again, no guarantees right now. What we're looking for, if this is wave 1 here, we're looking for potentially a move as high as that, probably around the 65% area, 28.795. And then we want to see a rejection off there and coming back down. That should go up as an ABC. And so you want that coming down below that wave B. So, I don't know if this was an A and this was a B, this was a C here, then what you want to see is a reversal from this area down below wave B. And that should kind of all but guarantee that this is a 1, 2 here and ultimately heading down lower on that. But my big picture, for those of you that don't know, for silver, this is the one everyone likes to hate me for. I get a lot of hate mail, guys. You wouldn't believe it. People are so emotional as traders. Trying to get them not to be that way, but it is what it is. So looking at the possibility here of price, let me see here. Yeah, 1, 2 there. So basically this becomes corrective here. You get your B up here or your X up here. And then you get your Y or C down here below this swing low. Below this right here. It's around $11.64. And that's what you're kind of looking for. I think right here is probably a good target, this wave 4, the previous degree here, of the larger degree. That's about $8.35, $8.65 around that area. I think is a pretty solid target for that. The big thing here, guys, what you have to understand, if you don't trade metals, gold and silver regularly, here's the thing. Let me see here. Okay. So here's the problem. Silver generally tends to lead gold, okay? So you get silver up there at the top, usually right before gold. So you had silver go up and then gold followed. 2011 here, you had silver go up and then gold followed. The problem is gold's gone up here and silver did not lead. So when you look at how is gold supposed to perform, Historically, silver leads. If you come on back through here, historically, silver leads. It gets there right before gold or a little bit more before gold. This change in character going on here should be, should get you going, whoa, what's going on there? That's not following what it's done for decades and decades and decades. And instead of going, oh, well, but that could happen because, trying to find some reason, as a trader, you generally look at, you tend to put your money on things that tend to happen over and over and over again. There's no guarantee that what's happened previously is going to repeat itself again in the future. But you tend to take that position more so than not because historically that pays off more than not. It doesn't pay off to be contrarian all the time in the markets. It doesn't. If you're contrarian for a reason, for an intelligent reason, something other than, oh, my Twitter feed, everybody is this way or that way, so I'm going to be the opposite, which is silliness. Don't do that. But if you've got real things like the metrics we continue to talk about, we've done over the last couple of years here, how all these signals are more extreme than what they were during the 2008 Great Financial Crisis, the 2001 dot-com bubble, 1987, the stock market crash in 87. All these heights that we've had, all the metrics from the type of euphoricness to what's going on with advanced declines in the particular stock markets, all these different things, they're all right now well above what they've ever been, except for maybe around the Great Depression. Even though some of them are better than, or are even worse off than what they were at the Great Depression, the height of that, before that came down. And so those are reasons to be contrarian. But even being contrarian doesn't mean that it happens overnight. You got to think, guys, we're talking about a grand super cycle. We're talking about 90 years. It doesn't flip overnight, guys. It takes a couple years. But we started noticing all the changes. If you guys were following me back in 2018, back there in 2018, we started noting all the changes going on there and all these things that were happening. And they've just continued to build since then. So, I mean, we can't give, can we guarantee that prices is going to go, that it's going to reverse and we're going to get all this? No, we can't guarantee it. Just like nobody can guarantee you that you're in a new bull market that everybody seems to think. And in the stock market after the slowest or the shortest bear market ever in history, which moved the fastest of any time in history. I think that was a warning shot, guys. If we check in here from, let me see here. Let me get you something. Let's look at the S&P. Well, you know what? Let's look at the Dow Jones here. Let's look at the S&P minis. That gets a lot of attention. So when you look at stocks, you see where we are here. We're potentially at a top. I think we've got potentially a little bit higher to go here. We've got room to go. So we may see it get to this pattern target up here around the R2 pivot on the H1, which will change next week. But, that's right up to around 3,900 or so. I think we might see that. That's your S&P minis. Your NASDAQ. I'm going to show you something here in a minute with the Dow Jones. NASDAQ, same idea. Making a slightly higher high here. Potentially going to get up here to the R2 at around 13,830, potentially. But you notice the difference here. Your NASDAQ, your Stochh RSI is topped out. If you look at your S&P minis on the 1 hour, they're lower here. But again, that same issue I talked about on another chart, it just kind of dipped right into oversold and pushed right back out. And so most often it leads to this right here where, where it continues to kind of go down lower on that. As you do that. This was this one back over here in the end of January. So, I'm not overly convinced that this has a lot of push in it, but just in case we've got our target up there where it may lead toward that pattern target. But the Dow Jones is your, remember your NASDAQ is very tech heavy. It's almost like a sector index, almost. Your S&P minis, your S&P is almost, it's not quite the extent of NASDAQ, but it's heavily tech as well. And tech's what's leading. We know that, right? Your Dow Jones is going to be your broader based market, more than just tech. So as you can see with this one, unlike the other two, we have not made a new higher high yet. Now, I think with the proximity, we probably are. And in that case, we might see a move up here to the R1 or the R2 here at 31,590. Again, same thing across all of them, right? But we are topped out well over here in Stochk RSI, and we've been for a few hours on the 1 hour. Now, here's the thing. Let's go ahead and zoom out here a bit. This is the monthly chart. This is the Great Depression here. I have it in here, okay? This is the height of the market there in 1929. Large drop here. That drop, guys, was 90%. It took the market until around... So it dropped here. It hit the low here. It took it about almost 2 years. Actually, almost 3 years here to reach bottom, right? And then from there, from 32, it took until 55 just to reach where the market was prior. That's 23 years. That's almost a quarter of a century just to reach where it was prior. And this is why I tell you, buying the dip is a great thing if you're young or if you're pretty sure you're not at a market top like this. But if you've just started investing today and you're doing the buy the dip thing, or not buy the dip, I'm sorry, the what do we call the where you've got your dollar cost averaging in, and so if you do that, then you know you're going to get caught up here at the top. That's the problem. You're going to get caught at the top. And do you have the time? If you're 40 years old, do you have the time just to break even? You don't. So you got to be smart if you're dollar cost averaging in. But this is what we're looking at here. So we're talking about this cycle right here. We're talking about this right here. This is the big cycle I keep talking about. That's your credit bubble. That's your grand super cycle top there. So that's the concern right there. So that's kind of where we're at, guys. Long story short, that's kind of where we're at. We'll see how it continues to play out here. Pay attention to where how we do up here if price makes it up here. But other than that, man, you know what? Just join us over there at howtotradetowin.com. We'd love to have you with us. Got so much more information, so much more discussion, a lot of really smart people in there. So we'd love to have you guys there. Anyway, I'm going to get out of here. I'm done. Y'all have a fantastic day. Trade safe. And as always, remember, the only thing you control in the market is how much you lose. That's it. So risk management is the most important thing you're going to do on a daily basis as a trader, all right? You guys have a great day. Thanks so much for joining us today. And we'll be looking forward to seeing you on Monday. Take care.